And joining me on the podcast right now and on video, it's full-time investor, equity analyst, Paul Hill. You all right, fella?
Yeah, morning, Justin.
It's been a big week. We've had the budget. We've had lots of companies reporting. What's been sticking out to you, Paul? Give us an overview.
I mean, a great question. I mean, I think we're still sort of like bashing through some of the lasting effects of the pandemic at different places in the world to a certain extent. I mean, you've got obviously the quarter through banking. Sorry, we've had the Q3 reporting season kicked off out in the States, and we had the banks to start with last week, and we've had Lloyds, which is one of my shares, only yesterday. And what we've seen there is they've had massive profits, which has been great. So you've had that sector which is doing really well, as largely with the provisions which were done on the for COVID 12 months ago have been released, and they've started to see the benefit from the yield curve. You've also had the oil stocks as well, which have sort of roared ahead because of there's been no investment at all in exploration. The world is starting to open up, so demand for oil has gone up, which has been great. But equally, last night you saw supply chain issues still struggling with Amazon and with Apple. How that'll affect some of my portfolio, like with Boohoo, and I've got in too early on that one, it seems. I still think it's going to be good long term, but clearly I could have bought it at a cheaper price. I mean, what you're seeing there is price escalation. You're seeing in raw materials. You're seeing also some freight problems, and obviously, with Apple in particular, you're seeing chip shortages as well. So you've got those sectors struggling a bit, and then likewise, I've had a lot of. Just recently, I had, yesterday, Gilead after hours, and I had Merck reporting. But it's really, again, sort of symptomatic of the whole of the healthcare space that we're still seeing hospitals overburdened in places like the UK, parts in Europe, and also specifically in the States. And if you're one of those businesses that supply sort of older traditional therapeutics like oncology, cancer drugs, you're also providing HIV and Hep C, then those types of the existing businesses are still struggling to get access to patients. But if you're supplying, you're doing sort of COVID testing, that's still roaring ahead, no doubt about it. It will obviously slow down going forward. Gilead came out with its remdesivir, which is the antiviral, blockbuster sales as well. So you've got to sort of like still pick through the pieces, and we're going through this transitionary stage. And it just occurred to me, just on that healthcare side, we've obviously discussed Polarean ad nauseum, etc. Well, one of the key themes which has come through from the healthcare results so far is that where you have existing treatments or new treatments coming in that are low touch to hospitals, they seem to be getting the nod through the FDA a lot faster than higher touch. So if you're, for instance, if you're doing tablet drugs, you're doing injection drugs, you basically have got a very good chance of it getting approved as long as the safety, efficacy is there. But if you're doing it for things like infusion, i.e. such that you're having to take an intravenous drip and it's taking 6 hours and then you're gonna have to stay in hospital for observation, then that is causing a burden on the hospitals and therefore is getting less sort of attention by the regulators. And the only reason why the read across I see for sort of Polarean may be another factor was such that obviously if you're retrofitting stuff into MRI scanners, for instance, then you access basically for patients coming in to get scanned is still difficult for hospitals because they want a light touch, and therefore you're seeing telemedicine doing very well. You're seeing tablets; they're doing obviously very well. You're doing, anything that can be pushed out to point of care, remote diagnostics, or into GP. Effectively the GP hasn't got a CMA as well. Anything which is light touch is doing well. So the big picture is coming back to the original question. Every sector almost is still going through a transitionary phase. Every geographical region is still going through a transitionary phase. Obviously, the UK is quite ahead. The US is doing well, but China is still a long way behind. And we're seeing that with hard lockdown still at its docks and getting supply chain. And that's impacting. And so all I would say is that, the stocks I've got, and certainly probably you've got as well, some of them are doing well, some of them are doing less well. And we've probably seen over the last couple of months, it's been a bit of a ho-hum market. Some of them, you know, you may have tread water, you may have gone down a bit, but you've got to stick with those theses you've seen, you know, your investment theses, and look through the sort of the cloud. And as long as your companies are going to emerge in the next 12 months, all I would say to investors, if you have been getting a bit of pain, and I've had a bad pain obviously in Boohoo, for instance, you know, if you've seen that, then don't worry. If your investment case and you know what you've done is sound, then you probably have a very good 2022, 2023. And so I always like that. I mean, I remember when we turned the clock back 12 months, I think you were absolutely skiing on 10 skis. You were. I mean, your portfolio was just going to the moon, and you're having a great time. And you had a really good first time. And I was saying to you, God, my portfolio is a dog at the moment, but I'm really looking forward to a 2021, 2022. And that's how it's panned out. So all I would say is don't get too dispirited. There still is a lot of noise out there. And just look at obviously the travel sector and the airlines and the leisure and this sort of stuff. But look through it. If your companies are good and they've got sound investment cases, long term you'll do okay. And that's one of the reasons why, you know, Boohoo, I mean, I can't believe I've lost probably 30-40% of that investment already in a matter of weeks. And I look at it, but I'm still very confident about the investment case.
Yeah, well, I said to a lot of people, I said, listen, this last 5 months have been very hard. It's literally, you know, nothing's really happening. It's grinding sideways to lower pretty much. And I said, it's one of the hardest periods, because I suppose I'm more active, just looking at them all the time. But one of the hardest periods mentally, just to say, what is going on? There's no liquidity in the market here. And I said, it won't be like this forever, you know. And as soon as we get over it, almost forget about the bad times, you know. But yeah, do you know what? I just looked today, just looking at AIM, for example. It's the top biggest companies, biggest fallers on AIM. And unbelievable, even big companies, you know. I mean, IG Design Group down 57%, Avacta down 53%, Asos down 51% over 6 months, Novasight down 47%, Amryt down 47%, and Boohoo down 44% over the last 6 months. And again, wow, they are big. And look at THG Group as well. It's a lot of big hits here, you know. And but yeah, looking at the supply chain, because a lot of companies said this. I mean, Amazon especially, they halved their profit pretty much from 6.3 billion down to half in the last quarter, Q3. Of course, we were locked up last time, and Apple complain about supply chains and all this stuff. So when do you see, or do you predict, or do you have a time in mind when these supply chains will ease up a bit? Maybe shipping costs, well, they are coming down a little bit. They're still quite high. But when do you see this happening? I mean, is it after Christmas? You think it'll just naturally, you know, ease up a bit, and we'll start seeing a bit more trade going on easily, you know, less costly trade anyway?
Yeah, I mean, again, an excellent question. All I would say is that, you know, when is China going to basically free up? And I mean, it's the manufacturing basket of the world for all things sort of like goods, and obviously places in Asia. I mean, it isn't just China for sort of like, you know, sort of like most electronics and stuff like that. There's also places like Vietnam, which is obviously a lot of garments and stuff as well. So you've got other hotspots which have locked down in Asia. And it's when those guys get fully vaccinated, then that will alleviate the supplies. Because what I mean, look at China. I mean, basically you've got not only that they're locking down some of the docks and locking down some of the factories, but they're also shutting them in terms of, you know, not allowing them to just turn the power on, you know, sort of like most of the days. So that's got to finish. And all I would say is that I'm sure they, you know, the authorities know what they're doing to a certain extent. They realise they want to get people vaccinated and back to work. I mean, I would say middle of next year, and then sort of like H2. By this time next year, we should have been through the normalisation of the supply chain. And so if you've got...
And markets look ahead, don't they? So the markets look ahead. So we'll start, I assume the stocks will start to rally before that. You know, you'll start getting evidence before that, and then it'll start moving up, won't they?
You would have thought so. But, yeah, I mean, you know, the markets will start pricing in 2023 earnings a bit more in terms of sort of like certainty, sort of like this mid next year. So you're probably right to a certain extent. That's the sort of the timing. But let's be clear about it. You know, you and I are what? I mean, we're older than, you know, we're sort of over 50. I'm a bit older than you. But, you know, we're still relatively spring chickens compared to Warren Buffett, who's 90. And if we're investing for another 20, 30 years, then 12 months, I mean, it makes an awful difference, doesn't it, really? And the key is, to a certain extent, is that you have a relatively diversified portfolio that isn't going to be all knocked at one time and then all roll back at the same time. Or if it is, then you can take that real pain, so you split it. So, something like my portfolio, I've been, battered on boo-hoo, but the other parts have done okay. And so, I've actually done a bit of portfolio pruning as well. I've sold my Grainger shares, which were the UK, largest private landlord, and then redeployed some of the funds into Amryt Pharma, because I mentioned to you that I bought those shares about a couple of months back, but only had a half a position. So I now have a full position of Amryt heading into their interims next week. But their big event is the 30th of November, when they're hopefully going to get FDA approval for their new oleo gel for EB skin disorder and stuff like that. So I'm sort of positioning it more into healthcare. And again, it comes back to the relevance, which parts are in healthcare. As I say, it's low touch in hospitals, but equally, the advantages with healthcare, it's got massive IPR, barriers to entry, pricing power. It has no problem at all in supply chain, difficulties, stock shortages, because when it comes to manufacturing, it's dead easy to make a pill, or a relative drug that you don't need huge amounts of you need a vial, which can be difficult to get to a certain extent, but most of the time, unless you're putting a vaccine out, it's probably pretty much easy. So the key is for your portfolio to have that balance, and to have some stocks which are doing okay, and some which are not, maybe you struggle a bit, and you're still sort of like flat line or go up or whatever, but it'll be mirroring your risk tolerance level.
Yeah, but I suppose, I'm looking at my portfolio. I mean, there's one stock really that was exposed to supply chain issues, and they issued a trading warning. That's Biome Technologies, which announced some news this week, commercialization of biodegradable tree shelters. That's
amazing, isn't it? Biodegradable tree shelter.
I didn't realize,
what was the shelter for?
No, but I didn't realize that most trees, up to 80% of trees can be killed. They're planting trees, of course, a huge thing at the moment, tree planting. And in fact, you see today, there's a guy, CEO, I think of Reddit, who's high up in Facebook and one of the tech company. He says, and this is a big goal, but he's at the company, he said, do you know what? You can dwarf carbon capture technologies just by planting trees, but you have to plant loads of them. And he's saying, you plant a trillion trees, and it's the size of America plus Mexico. It'll cure climate change. But he wants to, obviously that's the big target. But no, in this country we're going to triple our tree planting, and Biome Technologies just done a commercial deal with Sure Green. They lab tested these biodegradable tree shelters, because they plant a lot of trees. A lot of them get damaged by like deer or squirrels before they start growing. So they've got to protect them for the first 3 years. And these shelters will break down. I think it's 2,500 tons of plastic is left in soil. They're not reclaimed. They just don't break down the traditional plastic.
But what are the shelters to shelter? Is it an animal?
The trees.
The trees. To shelter trees.
From the animals. Yeah.
Oh, I see. Right, gotcha.
And the stats are like anywhere between, I think it ranges depending where you are and what wildlife there is, but from 40 to 80% of trees get decimated by wildlife. And they're saplings. They first start off, of course, they're killed. So that costs a lot of money. But trouble is, of course, there's plastic pollution in the ground, because you leave those shelters there, they're not reclaimed. But these ones degrade after 3 years, biodegrade by bacteria. And so they've just done a commercial deal with that. But no, the only company I have that was exposed to supply chains was Biome Technologies, pretty much, because they had their customers in America with the coffee pod materials and all this stuff. And they give a profit warning about that. It dropped like 23% in a day. It's now bounced back. So I'm okay. Everything else, TrueFin is fintech and gaming. Gfinity is gaming and at home sort of stuff and all that stuff. Escape rooms, is fine. So Polarean actually took another big hit on that. I spoke to Richard actually in the week from Polarean, the CEO of Polarean, and he got me the impression that FDA phenomenally overworked.
Yeah, and, I know. Yeah, they are.
To the point where they said to me, "Don't need a last meeting." Well, he wanted a last meeting, didn't get the last meeting. They knocked him back on a manufacturing issue. So why not the last meeting? And to them, it wasn't a big deal. They said, there's a couple of issues you can sort out. And he said, it's fixable, but if we just had done a meeting, we can address the problems. And so it's almost like it's a time to market is the issue here, but it's almost like the FDA haven't got time to even, question it and stuff. They just have to move on, knock it, move on to the next. It's so rushed off their feet. It's unbelievable. So
that's absolutely true.
Yeah.
You just look at basically the number of sort of antivirals going in, and the still sort of vaccines, which need. I mean, AstraZeneca's the vaccine still hasn't been approved by the FDA, which is just frankly nuts, isn't it? So it just shows
exactly.
you. I mean, that is a risk, obviously, for Amryt Pharma, but I still think, given that the FDA have been pushing that particular product, they've been accelerating the transition. I'll be very, very surprised if they. I'm sure it. Well, let's see. I don't know.
On supply chain things, though. By the way, I mean, stocks like Boo now. That's the supply chain issues are now, and the costs are sort of priced in, aren't they? They've got to be. So if you're looking for bargains now, I assume all that stuff is right priced in, isn't it?
Yeah, I mean, more than priced in. I mean, you look at the shares for Boohoo. Last time I saw, they're about 180 or 190 or something like that. And I mean, everything in the consumer space has just been absolutely hit. As you say, from the Hut Group, ASOS has been annihilated. Everything's come down. Another one which has come down, totally unfairly, is Revolution Beauty. And they announced earlier this week that they have just done an acquisition, which was flagged at the time of the IPO, that they were going to buy their manufacturing, or effectively their third-party manufacturer, who's just next door with them in Kent, in Queensborough. And just give you a bit of history, Revolution Beauty was started by sort of the two founders, the CEO Adam Minto and the exec chair, who's Tom Allsworth, back in 2014. So that was from a standing start. But Tom also at that time also had a cosmetics business, manufacturing, did hair care, skincare, etc. And then, rather than actually having a separate factory, they decided to use that and have a supply agreement between Tom's existing company, which is called Medicare, and Revolution Beauty. And effectively, Medicare supplies is 90% of its turnover is straight into Revolution Beauty, mainly on the skin and the healthcare, etc., which has gone really, really well. And it was flagged at the IPO that Revolution Beauty would use the funds to, when it had the capital, to then buy Medicare, which it has done through exercising its sort of call option for £23 million, and that will be paid over 4 years, £7 million up front and then £4 million. The deal is significantly earnings accretive, and what I think strategically it just makes perfect sense, because we're obviously struggling now with supply chain issues. It gives them more security over that, more visibility, but equally it gives them more adaptability and flexibility, and there's a bit of R&D in there as well, so a greater expertise in terms of being able to turn new products round quickly, which is really a key USP of Revolution Beauty and a key, performance metric in terms of, it's 24/7 world, whereby a lot of their end customers who are the younger demographic are sort of like, very much sort of like influenced by endorsers online and on social media, and they want to change fashions very quickly, and therefore to be able to have that innovation cycle speeding up because they have this manufacturing facility as well and extra R&D resource gives them that strategic edge against their bigger brands. But the shares have come down to about the 125, 26 when I saw them last time. They're floating.
120. They did up today. 129 today.
Yeah, I mean, it's totally unfair to a certain extent. It just come down like with Boohoo, but the good companies.
Well, I was surprised at that, because we talked about the figures. We said, strong H1 sales growth, 35% at 78 million, and we talked about this, and I said they were flying, and all of a sudden you realise it's a problem sometimes. Everything gets sort of, considering that kind of sector, everything gets knocked. And I saw the chart like yesterday. I thought, what? What's happened there? And I thought, and that's a typical example. It's not the business; it's just the share price, And you have sometimes, like I say, if you do enough research and you have confidence and conviction in the company, you'll see this as opportunities. These kind of dips, they are opportunities, because it's not going to last forever, and it may last for a bit longer than you think. But you've got to have a bit of patience, haven't you? That's all,
Yeah, exactly. Just on the valuation, I mean, I think Zeus Capital, the house broker, put out a note, and I mean, their DCF derived valuation is £2. You know, price target is £2.1. But I would say I still think they're very much on track to double turnover over the next 5 years. I mean, they did 35% in the first half, like for like growth. And if they do that, and if you just put a modest sort of like 12.5% or 14%, you know, sort of EBITDA multiple on it, and then margin, and then a 15 times EBITDA margin, you're getting, I mean, I calculated this morning, you're getting around about 250, 270p. But if you believe, I mean, Adam's got, you know, a lot sort of bigger ambitions than that, and wants to get the sales up to £1 billion from 200 million, £1 billion in turnover over the next 5 years. And if he manages to do that, you can see this could be a 10 bagger on the actual share. So looks to be massive upside there in terms of, you know, what it can do. So, you know, again, it's that classic sort of the baby's been thrown out with the bathwater. And I'd say the same with Boohoo, as long as you've got a reasonable time frame. And then coming back to sort of like that whole thing we talked about in terms of the different sectors which have been hit. One sector which is battered, absolutely battered last year, was the banking sector. And as I say, they've come back with roaring numbers. And yesterday, one of my stocks, Lloyds, which I still hold, came out with better than expected Q3 numbers. They upgraded their forecasts. But what was really interesting, and I know a lot of investors hold this share still. I mean, you know, the shares are still only 50p this morning. Pandemic, they were about 60, 65. So they haven't got back to pre-pandemic levels yet. So, you know, even though they've come up from a low of about 22, 23p, I mean, it just shows you how absolutely crushed it was last year.
So why are the banks doing? A couple of banks have come out, Barclays, all that, doing quite well, aren't they? So why are they doing so well?
You've got your different parts. So if you've got your money center banks, they've done brilliantly on the investment banking side, M&A, advisory, trading, debt issues for companies and all that kind of stuff. But Lloyds hasn't really got the merchant banking side. It's really the sort of a commercial bank and the Lloyd, you know, basically just a straight mortgage bank. But essentially, its profits have come back so strongly because it made these enormous provisions at the time of the pandemic, and is now because it doesn't need them. It's now starting to release them. Plus, never waste a crisis type attitude, and it's really sort of like nailed its cost base. So its income cost ratio has come down to below 50%. I think it's about 48, 49% in Q3, and that's driven the return on tangible equity, which is really how the share price will derive. And they reckon this was really, to me, was the big news yesterday. Management now have lifted their guidance for return of equity of above 10% for this year. Now, underlying, and that's really important because, you know, if you take a cost of equity, let's say just broadly 10%, it's less than that, but let's say 10% for say Lloyds, because it's a really, you know, it's securitized lending against people's houses mostly. But if you lose 10%, then you should be sort of like looking at a 1 times book, or at least a 1 times tangible book value. And tangible book by the end of this year or early next year will be 60p a share. So you could see that. But that isn't, again, you know, what's interesting is the 10% for this year is the low watermark. Because if you had there was a really fascinating slide that they put in, and I can't remember what number it is, but it's in there. It's in the appendices. But they did a sensitivity on interest rate moves, and they reckon if interest rates, gilts go up from 1% to 2%, for instance, they'll make another, in after-tax profits, they'll make another £1 billion in earnings. You add that into their, you know, basically their numbers, then you push up the return on tangible equity from over 10% to over 12%. And if you're over 12%, it'll be a 1.2 times book in my. So my fair value for the stock is over 70p. 60p times 1.2 is over 70p. But I have seen some of the you know, the actual big broker banks pushing the return on equity to 13.5%, and I think Citibank came out with a price target of 90p yesterday. So there's still plenty of gas in this. there's still plenty
Do you
of
know
gap.
what? I opened the Lloyds, sort of release there. And I thought, oh wow, there's a lot of figures in there. So for people who are, and I like, that's why I like quite like sort of micro caps. It's quite simple there, but banking releases always, results are quite complex, aren't they? So what do you, if you had to, advise, say, a private investor looking to Lloyds now, what's the figures you look at? Is that what you look at, just book value and return?
Yeah, I mean the two biggest ones I look at are book value, and then the sort of the underlying level of return on tangible equity, and whether that's increasing, which reflects the efficiency. And the other thing, which is quite good if you're a bit of an income boy, which I'm not to a certain extent, is they've got, in my view, just running the numbers, they've got £5 billion of surplus capital. Now, one way of improving your return on tangible equity is to obviously improve the efficiency of the business. The other way is to get rid of spare capital that's dragging it down. So that's a 7p a share dividend coming, in my view, or through share buybacks. One of the two.
Yeah, or they'll probably buy Satago or Trufin.
Hopefully not for £7 billion.
hopefully it will.
Well, it would be for you anyway. But as a share.
In fact, you haven't mentioned it yet, but I saw some news from Equals. And,
exactly what I was going to come on to. Was that a major announcement or what? I mean, to have to do a single transaction forex for a large, obviously, institution to drive £1.5 million in revenue, it must have been a multi-hundred million pound, transaction to get a commission of £1.5 million. Okay, it's a one-off, but I think they'll probably do more one-offs even next year. And I used only a modest drop through EBITDA of about sort of like 20%. So I pushed up my forecast for this year. I've still hasn't changed the sort of like my fair value of a pound. But I think what it sort of like underlines is that this is a platform. This is a platform company that has best of breed banking technology that even large institutions now are using to do its forex and foreign payments. It's avoiding the banks, which says a huge amount about the technology and will be a massive endorsement going forward to attract new customers. I mean, I don't want to be too positive on this one, but I have been banging the table for 12 months on it, yeah? But the shares, around about high 60s, 70s, 67p today, 67.5p today, I can see. And on that basis, a quid is certainly not a stretch. I mean, I could see this getting to 150 in the next 12 months. I mean, you remember when I said to you, there are two stocks at the start of the year, which I think could do really well and are Equals and Northbridge, But I think I'll be saying the same. I'll be like a broken record. I'll be saying the same to you at the end of this year. Those two have still got shed loads of upside.
Well, I saw that. I thought that's good, because 1.5 million, of course, is not hugely significant for the top line. But as Ian says there, it represents the largest single transaction ever completed by a group, and is a clear demonstration of our credibility among large corporates. And of course, that gets around, and word of mouth, and that large corporate will probably do it again. And so it can become a regular thing, So once you do that one, it's a milestone. I say largest single transaction. It's a milestone there. If it's a new benchmark, and that raises the bar fund, doesn't it? And
and they're still cheap. I mean, I haven't changed at all my 2022 forecast. I mean, I have posted them on. I just changed my 2021, so it's pretty conservative. They're still only trading on 2.5 times EV sales for next year. The sector's on over 6 times, and given that they're a platform stock, I mean, I could see. Well, once you start seeing the operating leverage come through, you're going to get accelerated sales growth, and you're going to get increase in your multiple. I mean, as I say, let's just hypothetically say, okay, they get to a 4 times multiple, and they hit 50 million of turnover, okay, then 4 times more is a 200 million pound, EV. The number of shares they've got is 180. So I mean, you've got over £1 there. You've got £1.10, and that'll still be on a modest 4 times valuation. So it's just not. We're not sort of like totally out of the question that could that occur. So still plenty of upside there for me.
Yeah. The chart is looking nice. Do you know what? It's got this. It's tried to break that. What is it? 70 pence level. Once it breaks that, I think momentum kicks in and you get some money flowing into it there because it seems to taps that twice or three times there. Yeah. So once it breaks that 70 pence level, I think it's off the races there.
Yeah. Another one in the actual healthcare, which I haven't talked about, which I should do, is Belluscura, because they signed their 5th distributor, which was about not last week but the week before, in the States. And what was really key about that is that now they've got almost like full coverage for their portable oxygen concentrators over the North America. But also they got more orders in, and they've already earlier, after 9-10 months, they've already beaten their full year projections. And it doesn't, because it's a high value item, this, and they're well cashed up. Then it looks as though they'll be profitable in a couple of years, in 2023. So they've got a lot of strategic optionality built in there with that cash pile, and they're really sort of already beating their expectations. So, and the shares have responded well. I mean, I know we talked about it when they listed. We thought they were really cheap. And I think they're about 90p a quid, and they listed?
Yeah, 96 pence now. They listed. They opened.
It's about 40p, 45. I can't remember what it was. It was ridiculously cheap at the time.
Well, 51 pence essentially here. So it really pretty much doubled, close to doubling in since IPO.
Yeah, I think that was the first day. I think they actually listed at less than that. So anyway, but regardless of that, again, I think the actual addressable market is huge on there, and the statement that CEO Bob Rorker says, the demand has been excellent over the past, since listing in the last 5 months. And they've been, relatively easy to put in distribution agreements, which says a lot about the quality of the product and the technology. And if you think about it, you come back to my comment originally on healthcare. What we're looking at, what the healthcare systems need going forward, is low touch equipment, drugs, and anything that can take some of the resource strain away from doctors, nurses, and consultants. And portable oxygen concentrators does that perfectly, because it allows sick patients to get a better quality of life and be treated at, and importantly, underlined, at home. So that's one of the reasons why these things are going to go. They're basically selling like hotcakes. These things are.
Yeah. No, they did list for 45 pence, raised 17.5 million, 45 pence. Yeah.
There you go.
So 96 pence now, so they're doing well.
Yeah, well, wow. and then again, I just fell out the blanks on, just on Merck, who put out their numbers yesterday. The shares were up sort of 6-7% on the back of it, and they're sort of like flagship oncology. It's basically an injection, which is Keytruda, which is the world's #1 checkpoint inhibitor for immunotherapies, and it's increasing sales 20% per annum. So it's really driving that top line a lot. And then, as I mentioned to you, about the last time we spoke, they came out with a blockbuster therapeutic, which is absolutely fabulous, that is just going through FDA approval, but has already had pre-ordering across the world, from Asia to France this week as well. The States has obviously decided to get, I think they spent 1.6 billion pounds pre-ordering, some tablets as well. So that's really going to drive the top line. I could see significant upside next year, in terms that market is expecting $5 billion of turnover for that drug, molnupiravir. But I think they could blow through that absolutely easy, particularly when their biggest competitor, Roche, didn't make their endpoint goal in phase 3 trials, which means it's a big hole in that respect. So, I think Merck will do well, continue to do well, and I could see those shares going well above $100 from. They're up now to they're 86. And the other one, which came out with numbers, which wasn't as good as last, they beat expectations, was Gilead last night. They've got the first generation antiviral, with remdesivir, which came out with some good numbers, but their existing business is still being, particularly their Hep C franchise, is still being impacted because hospitals are just jam-packed with COVID patients and treating, other conditions. Hep C then effectively, it's a tablet, which is great, but what they're seeing is that to get diagnosed for Hep C, and it's traditionally it's people who are intravenously swapping needles and stuff like that. It's passed through on blood to get Hep C. And then therefore, obviously, the drug community is one of the biggest patient populations for it. They're not getting themselves diagnosed or screened, so that's just building up the backlog, and that will come through. And again, we've seen anything that's with the NHS, my sort of like contacts within there, and I've spoken to a number of people, because they're going hell for leather in terms of anything they can diagnose, which is quick and easy. So things like blood tests is quite easy if they've got enough product, etc. Anything where they're doing screenings for MRI and this sort of stuff, or anything that's going to take a bed up for an intravenous stuff, is really quite a tough ask. So they're getting they're focusing, they're prioritizing on low-hanging fruit on patients, unfortunately, rather than sort of like potentially sort of like importancy. So I would say, Polarean, the big events happen, but depending on which parts you are in the healthcare spectrum will decide where you are. I'm still convinced, given all the holidays, PCR testing and lateral flow testing is going absolutely gangbuster at the moment, going just rocketing, because so half term, the airports have been pretty busy. People have been going
As far as Polarean is concerned, as now, because it's been pushed out, commercial shells have been pushed out 6 months at best, probably 12 months. So there's going to be no issues there. Hopefully things will. Obviously there's going to be a backlog anyway for a long time. But have you any more stocks to mention? Because I want to ask you about one macro issue.
Yeah, go for the macro issue.
So inflation then, right? Because everyone's talking about inflation and transitory. And I keep saying transitory is such a cop-out word, because everything's transitory. Our lives are transitory. Everything's transitory. So it can be as long as you want it to be. But what's your thoughts on inflation here? And also, will companies, manufacturers bring prices back down if costs come down? Will they reflect that to the consumer?
My view, it hasn't really changed to a certain extent. I think there's going to be more inflation than the market is expecting, because if you look at the break-even rates out in the States, we're looking at around about 2.5%. If you look at the five-year, which is obviously higher than where the Federal Reserve says its target is 2%. And then you look at the UK, and you look at the last time I looked at even just the short ends of the index-linked pricing for gilts, etc. You're getting break-even RPI rates. It's CPI in the States, but RPI in the UK. You're getting break-even RPI for a year of about 4%, and that's what a lot of people are saying. We're going to get RPI of about 4%. And you look at that and you say, okay, well, if the target is 2% in the States and effectively 3% RPI in the UK, because it's 2% CPI, then what the hell are the Bank of England and the Federal Reserve? Well, they're saying one thing, i.e. they're going to basically now tighten and reduce QE to take some and push up interest rates. And yes, I think they'll obviously reduce. They'll start the tapering in the States in November, and we've already started tapering in the UK. But in the Bank of England will start pushing up interest rates by the end of the year. But they don't want to take the juice out of the economy. So, what they say and what happens will be two different things. The Western world, needs to reduce its level of government debt as a proportion of nominal GDP, okay?
Yeah.
The best way of doing that is through higher than what the market's expecting on inflation. And they'll run it. They'll continue to run it hot. So yes, they'll push up interest rates, but essentially, when it comes back to your original question, will inflation stay high relative to target rates? And the answer to that is yes. I will be absolutely stunned, and I mean this underlined, if UK inflation is less than 3% in 2023. It's going to be more than 3% next year, definitely. But how much more is it going to be? And is it going to come down by 2023? And the answer to that is, so when it comes to your stock picking, then you've got to have companies with pricing power. Hence, I've been, again, like a broken record, I've been moving into healthcare. So a big chunk, 20%, I'll just tell you how much it is actually now. I think it's about 20% of my portfolio is in healthcare, if not more, or in, what is it now? Healthcare is, crikey, it's 23.5%, because I bought a bit more of, Amryt Pharma, or I put it into tech, which has got decent pricing power, or fintech, where you've got basically lots of growth. My software allocation is over 20%. Fintech is nearly 20%. So if I add all those three together, I get over 60% of my portfolio, which is either technology, IPR heavy, or healthcare. And then I've also into things like good pricing power in industrial, so things like Crestchick, which is obviously Northbridge, which is 12 and a bit percent, and the other bit is basically like Lloyds and stuff like that, and the financials, which don't have that much pricing power, but should do well in a higher inflationary world where they push up interest rates. So coming back to the original question, if you want it, if you believe like I do, inflation is not, we're not, the risk is not deflation, it's going to be higher inflation. Then continue to position your portfolio with pricing power, with IPR, with barriers to entry, and with growth. And if you do that, then if we do get a shock in terms of everybody says, crikey, we're not coming back to 2%, then at least your portfolio will be resilient. It won't be undamaged, but it will be resilient. And one of the beauties of having something in financials with the yield curve going up is that where you lose elsewhere, which I've done obviously in places like Boohoo, for instance, online, retailing, you're going to make up in the financials as the yield curve increases. So
yeah. And another positive as well is no point holding cash, is it? So people will start sort of deploying that, won't they?
Yeah, well, yes, they should do. Yeah, there's plenty of cash on the sidelines, no doubt about it. But this comes back to that original, and I'll ask you a question, okay? How do you distinguish between a value trap and a value play?
No idea. No idea.
You shouldn't say that. Okay, I'll give you the answer.
That doesn't play. When I'm investing, thing is, no, when I say you deep dive, right, and that to me is very complex. That model, I wouldn't even get into that. I genuinely look for good growing companies in hot sectors that are reasonably valued and are market leaders pretty much. And I don't really worry about pricing power. I look at the companies I'm in. I think they've all got pretty much pricing power. Do you know why? Because they're the best at what they do, or they're growing very quickly and they're not overpriced.
You've actually just indirectly or inadvertently answered the question which was coming. Because this is really, really key for investors. And if I'd say, forget what we've just talked about for the whole 50 minutes, if there's one thing people should go away with, okay, when you come to choose stocks in an inflationary environment, and with obviously a lot of the easy money's already been made on the stock market, which is the case has been, in particular sectors, when you just have to decide between what is a value play and what is a value trap, and I'll just say, let's just look at the oil sector, okay? You basically go for those stocks with IPR, which are quality, high quality stocks that can actually benefit in that environment. Stuff that is basically got the balance sheet, it's a low cost producer maybe, or is in EVs or in renewables, etc. You don't go for those effectively Me Too type sort of manufacturers or service companies, or alternatively, with high cost assets. So that's how you distinguish between whether something in a sector is a value trap, i.e. it's a poor quality company that the shares have gone up but will actually come down, or continued value play, which is higher quality, where you'll get through it and it'll emerge from the other side with a stronger competitive advantage. You answered that question.
I was stuck by a terminology there. I thought, right, because I never look in terms of that. I genuinely, I mean, when you're looking for companies, you look for a good company, don't you? I mean, a growing company, because I invest in micro caps, small caps. I'm looking for a good growing company in a very hot sector for a long time, not just a short-term trend. I mean, a long-term trend, hopefully. That's a good value, it's growing.
Yeah, but you can. But the point is, you can. A lot of novice investors can get sucked into that trap i.e. such that they look at something and say, oh, that's still really cheap. Yeah, but it's cheap for a reason. Hence, that's a value trap. Whereas something like Lloyds, for instance, is actually, it's got a lot of juice still in it, and it's it's the biggest UK mortgage holder. So all I would say, the balance of probability as a financial, if you look at the financial sector, then that could still do very, very well. And again, I would say for things like Amryt Pharma, for instance, and I'm really positive on Amryt Pharma over the next sort of like 2, 3, 4, 5 years, etc. The shares have come off. They're cheap, and that's why I've decided to up my stake. And you'd say, is the science any good? Well, it's world class. Their technology is excellent. They are not a value trap. They are a value, in my view. They are a total, high quality value play, and that's why I've pushed up my allocation. So that's what I was going to say.
No, I say to people, people say, oh, oil prices going up. I'm doing oil stocks. And I think, well, hang on a sec. First of all, we understand we're going to get to net, oil consumption. We understand that it's not a long-term trend, oil, and also, even though a company may look like it's generating good cash flow as an oil producer, you have to understand that the money outflow from oil is phenomenal at the moment, and just the ESG aspect of it is worth looking at. Like I say, follow the money. And so those companies now are afforded less of a multiple they were 10 years ago because there's just less people investing in them. So, I mean, that's why I say always look for long hot-term trends. That's what the ESG thing comes as well. But no, your terminology value trap and value play did stump me for a second there. Okay, cool, marvelous stuff.
You knew the answer. That's the main thing.
I knew the answer. I didn't understand the question.
I'm not sure I did either, so don't worry.
Marvelous stuff.
Yeah, take care, Justin.
By the way, just going to remind people, subscribe on YouTube if you want this on video, of course, to your inbox. In the meantime, it's on the podcast as well. Cheers, Paul. Speak next week.
Cheers. Speak to you 2 weeks. Bye.